Imagine a warehouse manager in New Jersey or a textile exporter in Mumbai staring at a shipping invoice last week. At the bottom of that bill sat a number that seemed more like a ransom than a tax: 50%. Between the base tariffs and the punitive, Russia-related surcharges, half the value of those Indian goods was being swallowed by the U.S. Treasury. It felt like a relationship at its breaking point, with Washington effectively treating one of its most important democratic allies as a financial enabler of the war in Ukraine. The atmosphere was thick with a sense of us versus them, a geopolitical deadlock that looked set to last for years. But then, on a Monday afternoon, the air suddenly cleared with a single phone call. The shift was almost jarring in its speed. Within minutes of a conversation between Donald Trump and Narendra Modi, the rhetoric of penalties and financing war vanished, replaced by an outpouring of friendship and respect. Trump didn't just trim the tariffs, he hacked them away, removing the 25% Russia oil penalty entirely and promising a path toward zero barriers. In exchange, India, the world's third largest oil importer, have agreed to turn its back on discounted Russian crude and pivot its massive energy needs toward the United States and Venezuela. It's a stunning reversal of fortune. One moment, India was being squeezed for its neutrality. The next, it is being hailed as the strategic partner that could end the war in Ukraine by cutting off Moscow's lifeblood. It leaves you wondering how a 50% trade wall could crumble so quickly, and what really happened during that phone call to transform a bitter economic standoff into what both leaders are now calling a wonderful area of limitless potential. Does this deal signal a genuine diplomatic breakthrough, or is it a high-stakes pivot that fundamentally rewires the global energy map? So welcome to a deep dive that is very specifically tailored to peel back the layers of this sudden massive shift. We're looking at a moment that might just define the next decade of global economics.
It's certainly a moment where the tectonic plates of trade and geopolitics just shifted overnight.
And today we're dissecting this massive trade deal announced on February 3, 2026 between India and the US. And to do this properly, we aren't just looking at the press releases.
No, the handshakes and the photo ops are just the surface.
Exactly. We have a stack of materials here: official trade briefings, raw Port Authority data from the Indian government, power sector analytics, geopolitical analysis.
And that data is so crucial. I mean, the headlines are all about friendship and respect, but the real story, the one that, actually matters for the long term, is hidden in those spreadsheets and logistics reports.
That's our mission for this deep dive, to look past those headlines and see how this deal actually rewires the machinery of the Indian economy. We're talking from the factory floor.
All the way to the shipping docks.
Right. Because when you strip away the diplomatic pleasantries, this is a massive gamble. A huge gamble on energy security and industrial output.
You're effectively trading a known, functioning supply chain for a promised market. And that's a big bet.
It's a huge bet. So I want to start with the first major narrative thread, which is about the on-the-ground reality of energy security. We can talk about billions of dollars in oil, but what does that actually mean for the guy running the machine?
Right, because energy isn't just a commodity to be traded on a screen. It is the fundamental input cost for everything else in a modern economy. It's the foundation.
I've been spending a lot of time lately looking into the ripple effects of the Trump-Modi trade pact, trying to look past the high-level handshakes and the 25% tariff cuts to see how this actually hits the ground. It's one thing to read a headline about energy security, but it's another to understand what it feels like when a nation's entire industrial engine has to switch gears, almost in an instant. And I've come across a few narratives, some from forums, others from local reports, that really paint a picture of what's at stake here. Imagine a man named Arjun, a shift manager at a massive textile mill in Gujarat. For the last couple of years, his plant's survival relied on the cheap, steady flow of discounted Russian crude that kept his electricity costs predictable.
The lifeblood.
The absolute lifeblood. And when the news broke that the 25% punitive tariff on Russian oil was gone, part of this pivot toward American energy, Arjun didn't celebrate immediately. I read about his skepticism online. He knows that security isn't just about who you buy your oil from, but whether the lights stay on during a heat wave. It's about reliability. He watches the grid frequency monitors like a hawk. To him, this trade deal isn't about geopolitics. It's a gamble on whether the American Energy Alliance can provide the same industrial resilience that China's state-backed energy giants seem to guarantee their factories.
That is such a powerful point.
I found his perspective just sobering. It reminds us that behind every strategic shift is a factory floor that cannot afford a single minute of downtime. I want to pause on that image of Arjun watching the grid frequency monitors. That feels like such a specific, almost, technical detail. Why is a textile manager so obsessed with grid frequency? I mean, usually when I think of power, I just think, are the lights on or are they off?
And it really gets to the heart of why industrial energy is so different from, residential energy. You or I, sitting at home, we don't notice if the power quality dips slightly. The lights might flicker for a millisecond.
Right. You don't even think about it.
Exactly. But Arjun is running massive high-speed looms and spinning machines, heavy, sensitive industrial equipment.
Okay, heavy machinery.
And that machinery is synchronized to the frequency of the grid. In India, the grid operates at 50 hertz. That's 50 cycles per second. It's like the heartbeat of the entire electrical system.
A constant, steady rhythm.
If that heartbeat becomes irregular, if it drops to 49.5 hertz or spikes to 50.5, it causes actual physical stress on the motors in those machines.
So the machines actually shudder or break down.
They shudder, they slow down, the threads on a loom will snap, production gets ruined, and in worst case scenarios, sensitive electronic controllers, the brains of the machines they just fry.
Wow. Yeah.
So when Arjun is watching that monitor, he's not just watching a number. He's watching the stability of his entire operation, his job, the jobs of everyone in that factory. And that stability comes from what we call baseload power.
Baseload.
Baseload is the heavy lifting. It's the power that is always there. 247, rain or shine, wind or no wind. In India, historically and still today, that comes from thermal plants burning coal and, crucially, oil.
Yeah.
And for the last 2 years, a huge chunk of the fuel keeping that base load stable, keeping that heartbeat at a perfect 50 hertz, was coming from Russia.
Because it was cheap and it was abundant.
It was incredibly cheap, yes. But more importantly, the supply chain was established. It was reliable. The ships knew where to go. The refineries were configured for that specific type of crude. It was a well-oiled machine, literally. Now, this deal tells Arjun, we are going to stop using that fuel. We're going to switch practically overnight to American and Venezuelan oil.
And his immediate worry is the new fuel going to get here on time in the right quantity and at the right quality to keep that heartbeat steady?
It's not just timing. It's the sheer volume. I don't think people fully grasp the scale of the plumbing we're trying to rip out and replace here. Let's actually look at the numbers. India was importing roughly 1.5 million barrels of Russian oil per day.
1.5 million barrels.
Every single day.
To visualize that, you need to imagine a constant, unending line of supertankers stretching out of the harbor. That volume made up more than a third of India's total oil imports. This wasn't a side hustle. This was the main artery of their entire energy economy.
A third of all their oil. More than a third. And the deal requires replacing this massive volume with oil from the US and from Venezuela.
Okay, so let's play devil's advocate here for a second. The US is the biggest oil producer in the world now. Venezuela has, supposedly the biggest reserves in the world. Surely, between the two of them, they can fill the bucket.
In theory, yes. On a piece of paper, the numbers might look like they add up. But in practice, geology and physics and, frankly, politics get in the way. Let's talk about what the analysis calls the Venezuela risk.
I was surprised to see Venezuela back in the mix. I mean, they've been out of the headline energy game for quite a while.
They have, and for a very good reason. The report uses a very specific and I think very telling word to describe Venezuela's oil infrastructure.
Yeah.
That's not a word you want associated with your national energy security. No. It means rusted pipelines that haven't been maintained in a decade. It means refineries that are operating at a fraction of their original capacity, if they're operating at all. It means a lack of skilled engineers because of the brain drain from the economic crisis there. You can't just flip a switch and get Venezuela pumping like it's 1990.
It's not just a matter of turning a valve.
It would take decades of sustained multi-billion-dollar investment to even begin to restore that output.
And right now, what can they actually produce?
This is the crazy statistic. Currently, India buys more oil from Russia today than Venezuela produces in its entirety.
Can you run that by me again?
It's the core of the problem. India needs to replace 1.5 million barrels per day. Venezuela's entire national production, everything they manage to pump out of the ground on a good day, is hovering around 800,000, maybe 900,000 barrels.
So even if India bought every single drop of Venezuelan oil, leaving nothing for China or anyone else,
they would still be short by nearly half. They'd have a 600,000 barrel per day hole in their energy supply.
that is a massive math problem.
And it means the bulk of the burden, the vast majority, has to fall on the U.S. But there's another more technical issue there. Not all oil is created equal.
What do you mean by that? I mean, oil is oil, right? Crude is crude.
Not to a refinery, it isn't. Refineries are built like giant, incredibly complex chemistry sets, and they're tailored for very specific recipes of crude oil. Venezuelan oil, like a lot of Russian Urals crude, is what we call heavy sours. It's thick, almost like molasses, and has a lot of sulfur in it that needs to be refined out.
Okay.
US oil, generally, especially from the shale fields, is light sweet. It's thin, it flows easily, it has very little sulfur, it's a completely different chemical composition. And many of India's major refineries were retrofitted and optimized over the years to handle that heavier, cheaper Russian and Middle Eastern crude.
So you can't just dump light sweet Texas crude into a refinery built for heavy sour Russian crude and expect it to work efficiently.
Exactly. You have to retool the entire facility. It's a major capital expense. You have to change catalysts, adjust temperatures, change pressures. It takes time, it costs a fortune, and it reduces efficiency while you do it.
Which all drives up the cost of the final product. The gasoline, the diesel, the electricity.
So Arjun in Gujarat is looking at this whole picture, and he's thinking, okay, my input costs are going to go up because U.S. oil is more expensive to ship across the Atlantic and Pacific than Russian oil was. My reliability might go down because Venezuela is a political and infrastructural mess, and my grid frequency might start to wobble because we are trying to rewire the entire global energy map in, a week?
It really puts the security part of energy security into a much sharper perspective. It seems like we are swapping the physical security of an established, functioning supply chain for the economic opportunity of a lower tariff.
That is the core wager of this entire deal. You've just summarized it perfectly. And it connects directly back to what Arjun said about China.
Right, he mentioned the Chinese state-backed energy giants. He seemed to almost envy that model. Why does the Chinese model feel safer to a guy like him on the ground?
It's the fundamental difference between what we can call a state capacity model and a transactional market model.
Okay, let's break those two concepts down. What's the state capacity model?
The Chinese approach, what we see with their global initiatives like the Belt and Road, is about ownership and physical control. When China wants to secure energy, they don't just sign a trade deal. They go to the source country, they finance and build the port, they finance and lay the pipeline, and often their state-owned enterprises, their SOEs, actually manage the extraction and shipment.
So they own the plumbing from end to end.
They own the plumbing, the road, and the tap. It's a completely vertically integrated system. For a factory manager like Arjun, that looks like the ultimate form of stability. It looks like a cast iron guarantee. The logic is, my government owns the well, so my factory will get the oil.
It removes the market variable.
It attempts to, yes. Now, let's contrast that with the US-India deal.
The transactional model.
Exactly. This is based on market access and diplomatic agreements. The core of the deal is, we will lower our tariffs if you agree to buy your energy from our private companies. It relies on the free market to fill the gap.
But markets fluctuate, and private companies have a fiduciary duty to their shareholders, not a strategic duty to the Indian power grid.
Exactly. And contracts can be broken, political winds can shift, tariffs can be put back up. We just saw that with the 50% tariff that started this whole mess. The U.S. proved very recently that market access can be turned off like a tap overnight.
So from Arjun's perspective, he's worried he's trading a concrete pipeline for a handshake.
A very expensive handshake. Now, to be fair, the analysis does mention the Shanti Act 2025 as a potential countermove here.
Yeah.
This is new legislation in India that opens up the nuclear power sector.
Nuclear, the ultimate unstable, non-fossil fuel baseload power, right?
In theory, it's the perfect solution. And the act is designed to allow U.S. companies with their advanced reactor designs to come in and build a new generation of nuclear plants in India. On paper, this is the long-term answer to energy independence. If you have a fleet of modern nuclear reactors humming along, you don't really care about the price of oil in Venezuela or political stability in the Persian Gulf.
There's always a but.
But building a nuclear reactor, even a modern one, takes 10 years, if you're lucky. More realistically, it's 15. This deal, this energy pivot, is happening now. Arjun has a shift starting tomorrow morning at 6 a.m. He cannot power his looms with a blueprint for a reactor that might come online in 2035 or 2040.
So there's a gap, a really dangerous gap between the present problem and the future solution.
A gap decade, potentially. A decade of heightened vulnerability. And during that gap, the risk is that he is trading a guaranteed affordable supply chain, that Russian oil, for a promise of market access to the U.S. consumer base. If the new US and Venezuelan oil is more expensive, less reliable, his factory's input costs rise. And if his input costs rise, it doesn't matter that the tariffs on his finished textiles are lower.
Because he can't afford to make the textiles profitably in the first place.
Yeah.
Or he gets outcompeted by someone in Vietnam or Bangladesh.
The tariff cut becomes meaningless if your cost of production skyrockets.
That is a very, very sobering look at the input side of the equation. But okay, let's look at the outputs. I mean, the whole reason India is taking this massive risk is for the economic reward. They want to sell more goods to America.
The pot of gold at the end of this very risky rainbow.
And I found another story that looks at exactly this side of the equation. This one shifts the scene from the factory floor to the port, from the point of production to the point of export. Then there's the story of Priya, which I stumbled upon in a logistics trade journal. She runs a small but growing export business near the port of Mundra, dealing in precision-engineered components.
High-value goods.
Exactly. For her, the reciprocal tax dropping from 25% to 18% isn't just a number on a spreadsheet. It's the difference between hiring 5 new technicians or staying stagnant for another year. I saw a quote from someone in her position saying, "We don't eat policy, we eat the output." She tracks the container throughput at the port with an intensity usually reserved for sports fans. If the ships aren't moving more steel and the national electricity consumption doesn't spike, she knows the deal is just paper. It's a harsh, bottom-line reality. Real national power isn't found in a joint statement in D.C., but in the physical, measurable surge of a port at midnight. It makes you realize that for the Indian middle class, this agreement is a litmus test for whether democratic trade can actually produce the tangible output that state-led models pride themselves on. We don't eat policy. We eat the output. I mean, that line just stuck with me. Priya doesn't care about the summit. She cares about the container.
And she is absolutely right to be focused on that. In the world of logistics and global trade, everything else is just noise. The only thing that matters is the box on the ship, and is the ship moving.
Yeah. Is Priya seeing what she wants to see? Is the port actually surging?
Well, if we dive into the hard economic indicators from the port data, there is definitely movement. It's not just talk. First, let's confirm the tariff relief itself. The deal drops the total effective tariff from that crushing 50%, that's the base tariff, plus all the punitive surcharges, down to a new baseline of 18%.
That is a massive haircut, more than 30 percentage points. That has to help.
It's a huge relief. The analysis calls it removing the tariff overhang. And that overhang was estimated to be shaving between 0.3% and 0.4% off India's entire GDP. Just removing that obstacle is a stimulus package in itself.
Just by not having that weight on the economy?
Correct. But the question is it translating to physical reality? Is the stuff actually moving?
Right. Priya's question.
And the data for cargo handled by major ports for the fiscal year April-March 2024-25 gives us a clear answer. The total cargo handled increased by 4.22% compared to the previous year.
Okay, 4.22% is solid. It's not, an explosive boom, but it's real steady growth.
But you have to dig deeper. That total number includes domestic shipping between Indian ports. The number Priya really cares about is the overseas cargo. That number specifically increased by 4.72%. So international trade is actually growing slightly faster than domestic trade. That's a very healthy sign.
And is there a geographic story here? You mentioned the port of Mundra where Priya works. Is that area seeing the benefit?
The data highlights Deendale Port, which is right there in that Gujarat cluster on the western coast, very near Mundra. It handled the maximum overseas cargo in the country. And some of the specific growth metrics for that port are staggering. We're talking over 20% year over year in some categories.
20%. Okay, that is a boom.
That is a boom. And it makes perfect sense geographically if you think about it. The western coast of India is the gateway to the Suez Canal, to Europe, and critically to the Atlantic sea lanes for the US. This data confirms that the western coast is the primary engine of this new trade alignment.
So if you're an exporter like Priya on the west coast, you are popping the champagne.
You are definitely hiring those 5 new technicians she was talking about. But let's look at what is in those containers and ships, because the manifest tells us a deeper story, the changing economy.
Okay, so what are they shipping?
The single biggest share by volume, around 31%, is POL.
POL?
Petroleum, oil, and lubricants. This confirms our earlier discussion with Arjun. The port is busy in large part because it is sucking in that new energy supply from the U.S. It's the lifeblood moving through the veins of the port before it gets to the factories.
Okay, so a big chunk of the traffic is the new oil coming in. What else is moving?
This is the one that really jumped out at me from the data, food grains.
Food grains, you mean like wheat and rice?
Exactly. The growth in food grain handling in the port for March 2025 year over year was 174.91%.
174%. That's not a trend. That's an avalanche. What is happening there?
This links directly back to the analysis of the deal itself. A key part of the agreement was India lowering its own barriers to U.S. agricultural products. We are seeing the physical evidence of U.S. agriculture almonds, cotton, soybeans, grains flooding into the Indian market as a result.
So the market access is a two-way street. American farmers are winning big here, it seems.
Huge. This is a massive new market for them. But what about Priya? She sells engineering components.
Right. She's not selling wheat. She's exporting value-added goods.
Correct. So for her, the category to watch is containers, and that category is up 9.49% in March.
Okay, nearly 10%. That's very healthy growth.
Containers represent the finished goods, the engineering parts Priya sells, the textiles Arjun makes, electronics, pharmaceuticals. This is the value-add economy. This tells us that Indian manufacturing is indeed ramping up to meet new demand.
So the ships are moving. The tariff cut is designed to boost those container numbers even higher. But Priya mentioned another indicator. She said she watches national electricity consumption.
Yes.
She sees that as a proxy for true industrial activity.
She's incredibly smart to do that. You can, fudge a GDP report or an export filing, but you can't fake the load on the national power grid. If factories are running 3 shifts, they are burning watts. It's an honest indicator.
So what does the power sector data tell us there? Is consumption going up?
The trend is very positive. Total electricity generation grew 5.21% in the 2024-25 fiscal year. That's a strong indicator of broad economic activity. But the most critical statistic in that report is the energy deficit.
The deficit?
It's the gap between the amount of power demanded by all the factories and homes and the amount of power the grid could actually supply at any given moment. A few years ago in India, power cuts, load shedding were very common because demand outstripped supply. The deficit was a real problem.
Right.
The data now shows the energy deficit is practically zero. It's fluctuating between negative 0.1% and negative 1.03%.
Meaning the grid is meeting pretty much 100% of the demand.
Yes. This is a crucial piece of the puzzle for Priya. It means the infrastructure can handle the increased industrial output she's hoping for. Unlike in previous years, where a boom in new orders might actually lead to a blackout because the grid couldn't cope, the infrastructure is now ready for that boom.
That sounds like all green lights then. The ports are busy, the grid is stable.
It's mostly green. But there is a very important piece of context we need to remember. This U.S. tariff reduction is a corrective measure. The data notes that because of those punitive 50% tariffs, India's exports to the U.S. had actually fallen by 1.83% in December 2025, just before the deal.
Right. So we aren't launching from a peak. We're digging out of a hole that was created by the tariffs in the first place.
Exactly. The New Deal stops the bleeding and gets things growing again. But whether it leads to that wonderful era of limitless potential the diplomats are talking about, that depends on whether that 9.49% growth in containers can sustain itself without the crutch of cheap Russian oil keeping manufacturing costs low.
That is the delicate balance, isn't it? We are fixing the demand side, getting Americans to buy more Indian goods, but we might be breaking the supply side by making it more expensive for Indian factories to produce those goods.
That is the central economic tension of this entire deep dive. Everything hinges on that balance.
Okay, we've looked at the factory floor with Arjun, and we've looked at the shipping docks with Priya. Now I want to look at the map, the big geopolitical map. Because this isn't just about containers and kilowatts. It's about who runs the economic world order in Asia for the next 50 years.
The geopolitical layer, the great game.
Exactly. And I found a story that frames this whole debate perfectly. Finally, I heard about a heated debate in a New Delhi coffee shop between an aging civil servant and a young infrastructure tech. The older man spoke of the Goldberg-Modi era as a masterclass in diplomatic maneuvering, playing the U.S. against Russia to get the best possible deal. A short-term win. But the younger man was pointing at a map of Asia, specifically at the massive concrete footprints of China's Belt and Road Initiative. He argued that while India gets tariff adjustments, their neighbors are getting bridges and power plants. It's a fascinating, if slightly polarizing tension. Try to imagine the pressure on the Indian leadership. They are betting on a system of bilateral deals and geopolitical friendship to provide the same stability that China provides through sheer physical infrastructure. It's a clash of models, one based on the fluidity with trade, the other on the permanence of concrete. I'll be honest, reading these accounts left me feeling a bit conflicted. On one hand, you can't help but feel the energy and the big win for Indian exports in a bold move to align so closely with the US while decoupling from Russian dependency. But from a grounded, perhaps more realist perspective, there's an underlying anxiety. We're watching a massive experiment in real time. Can a democratic trade alliance actually outbuild and outsecure a state capacity giant like China? It's easy to cheer for the friendship between leaders, but as these stories show, the real victory will be measured in the reliability of a power grid and the steady hum of a factory in the middle of the night. Deals versus concrete. I mean, that coffee shop debate really captures the whole economic tension of the 21st century so far, doesn't it?
It does. It's the clash of models we touched on earlier, but now we're seeing it writ large across the entire Asian continent. And frankly, the young tech guy in that coffee shop has a very, very strong point about the efficacy of the Chinese model.
Let's play that out for a moment, because in the West, we often hear about the debt trap narrative when it comes to the Belt and Road Initiative, or BRI. But from where that young tech is sitting, looking at a map of his own region, what does he see?
He sees connectivity that actually works. He's not looking at the balance sheets in Washington. He's looking at the physical reality on the ground. He sees the China-Pakistan economic corridor creating a new trade artery. He sees modern ports in Sri Lanka and Pakistan. He sees high-speed rail being built in Indonesia and Laos. These aren't just lines on a map or promises in a treaty. They are physical assets that tangibly reduce the cost and time of doing business across the region.
They are permanent. You can't revoke a bridge with a new tariff policy.
Exactly. The Chinese model is fundamentally infrastructure-centric. It focuses on creating collective economic survival and prosperity through physical connectivity. If you are a country neighboring China, you get integrated into a supply chain that involves new roads, new power grids, new ports, new digital networks. It's designed to create a deeply resilient and integrated regional ecosystem.
And the argument from the young tech is that this physical reality, this concrete, is superior to the transactional model the U.S. is offering India.
Let's look at the US-India deal again through that lens. It's based on this idea of friend-shoring, moving supply chains to friendly nations. And yes, in the short term, the stock market loved it. We saw IT and banking stocks in India jump 7% immediately after the announcement.
Because it opens the American wallet.
It opens the massive US consumer market, but notice the mechanism: market access. India had to make a huge commitment to buy $500 billion worth of U.S. energy and tech just to get its own tariffs lowered. It's a transaction, a very clear one. You buy our stuff, and in exchange, we'll let you sell your stuff in our market.
And as the young tech argued, that's fluid. That's not permanent. A new U.S. administration can come in, the political mood can change, and that market access can disappear with the stroke of a pen. We just saw it happen.
Whereas the bridge China helped build in Bangladesh is still going to be there in 20 years, cutting commute times and shipping costs, regardless of who is president in the United States.
That is a very powerful distinction. And looking at the regional context, it seems India's neighbors might be getting a better deal, even on the pure tariff front.
That's one of the deep ironies in the numbers. Neighbors like Vietnam and Bangladesh, who are deeply integrated into China's supply chains, but also trade heavily with the U.S., they still have better access terms. They have what's called GSP status, which means their average tariffs into the U.S. are around 5%. India, even after this great deal and all the celebration, is now paying 18%.
Wait, so Vietnam is paying 5% to sell goods to the U.S., and India is now paying 18%.
So while India is celebrating a massive cut from 50%, it is still structurally disadvantaged in the U.S. market compared to its key regional manufacturing competitors. Meanwhile, China's infrastructure-centric model is physically integrating those other regions into its own economic orbit, making them less dependent on the whims of the U.S. market entirely.
So India is in a really tough strategic spot. It has historically prided itself on being multi-aligned, friends with everyone, beholden to no one.
That era of strategic autonomy, buying advanced oil from Russia, selling generic medicines to the U.S., having a high-level dialogue with China, that delicate balancing act might be ending. By so decisively cutting Russian oil and committing to a $500 billion U.S. trade relationship, India is choosing a side. It is realigning very clearly towards the U.S. sphere of influence.
But is there a way for them to make this work? Can India use the transactional money to build its own concrete reality?
That is the multi-trillion-dollar question for the Indian government. And it brings us to the semiconductor risk that's mentioned in the analysis.
The chips. It always comes back to the chips.
Yes. There is a fundamental tension between India's stated goal, the India Semiconductor Mission 2.0, or ISM, which is all about building domestic self-reliance, building the chip fabrication plants at home. A tension between that and the nature of this trade deal.
So what's the conflict?
The risk is that India becomes just a low-level assembly hub. They import the high-tech, high-margin components, the processors, the memory, from the US. They have lower-wage workers, put them in a plastic case, and then they ship the finished phone or laptop back to the US. That creates jobs, sure, but it doesn't create real economic power. It doesn't create strategic autonomy.
It's the difference between being the architect and engineer who designs the skyscraper and being the construction worker who pours the concrete.
Analogy. But if India plays this right, if they are incredibly strategic, if they use the revenue from these increased textile and component exports to fund that deep tech self-reliance, if the profits from Priya's business are taxed and then funneled into building the nuclear reactors from the Shanti Act, or into subsidizing the construction of a world-class semiconductor fab through the ISM program, then the bilateral model can work. It can be a bridge to a stronger future.
So the strategy has to be, use the U.S. cash to build the Indian engine. Don't just become a cog in the American one.
That is the needle they have to thread. They have to ensure they don't just become a vassal state of the U.S. economy, completely dependent on U.S. energy inputs and U.S. consumer demand.
We started with a shipping invoice in Mumbai, staring at a 50% tax that felt more like a ransom. We looked at Arjun's worry about the power grid and whether American and Venezuelan oil can actually keep his textile mill running at a perfect 50 hertz.
And the massive, almost terrifying logistical challenge of replacing 1.5 million barrels of oil a day practically overnight.
Then we checked Priya's container stats at the port, seeing that incredible 20% surge in cargo on the West Coast, but also seeing that avalanche of U.S. food grains pouring into the country.
The output is definitely there, but the balance of that trade is shifting in complex ways.
And finally, we listened in on that debate in the New Delhi coffee shop about whether deals or concrete build a nation, whether the Chinese model of physical infrastructure offers a kind of permanent stability that the U.S. transactional model just can't match.
It really does highlight the core trade-off of this entire agreement. India has explicitly traded supply chain risk, its reliance on Russia for market access risk, a new and deeper reliance on the U.S.
The numbers, that 4.22% cargo growth, the zero energy deficits, the massive $500 billion commitment, they are all impressive. But as we saw with the Russian oil ban, economic deals are now completely indistinguishable from geopolitical alliances. You can't just be a trading partner anymore. You have to be a committed ally.
And that leads to one final and perhaps provocative thought that comes out of all this. Let's consider the Shanti Act again and the opening of the nuclear sector we discussed. This deal isn't just about oil or textiles or soybeans. A core, if less publicized part, is that the U.S. is gaining deep entry into India's civil nuclear power infrastructure.
Which is arguably the most sensitive, most strategic national infrastructure a country has.
So the provocative thought is this. By deeply integrating its core energy grid and its future nuclear infrastructure with U.S. technology and U.S. companies, has India effectively made its economy sanction-proof by becoming too big and too integrated for the U.S. to ever fail.
The idea being that if American companies are building the reactors and supplying the fuel and the technology,
then the U.S. can't place sanctions on India in the future without inflicting massive damage on its own corporations. It's a kind of economic, mutually assured destruction, a very clever strategic hedge.
Or has India, in its rush to get a better tariff rate, just handed over the keys to its long-term energy sovereignty in exchange for an 18% tax cut?
The question. And the answer won't be found in a press conference in Washington. It will be found on the flickering numbers of the grid frequency monitors that Arjun watches alone in his factory in Gujarat.